So, first of all, what do you mean by that exactly, and why do you think there's so much fiscal spending, or just spending overall from Congress right now?
So for the first one, fiscal dominance is basically when so monetary policy is things like interest rates or central bank balance sheet. Fiscal policy is like taxing and spending decisions by the government. And fiscal dominance is when that latter has a much bigger impact on the economy than the former. And more specifically, it's when the former, whose tools are meant to control inflation, are no longer able to control inflation because most of their tools are geared toward the private sector, whereas much of this is happening from that fiscal side, from the public sector, and central bank tools don't really address the fiscal side. Another way of putting it is that in an era where there's no fiscal dominance, higher interest rates should lower inflation because you're softening private sector credit creation and you're strengthening the currency from the perspective of foreign investors. But in a high public debt fiscal dominance regime, higher interest rates are not always negative for inflation because although they do put downward pressure on some of those private sector things, they put upward pressure on the fiscal deficit due to higher interest expense. And that's partially what's fueling inflation in the first place. That interest expense by the government is someone else's income, right? So for example, if I use myself as an example, I have a fixed lock-in mortgage and I have money markets. If they increase interest rates, they increase my income, which I can spend, right? And I'm not the only one like that. There's many corporations in that position. There are many households in that position, ironically. And so if the private sector termed out their debt and the government has not, and specifically that those levels are very high, that's where it starts to get a feedback loop that is not in line with what the past 40 years have been. And to answer your second question, why are they spending so much? I would say, I mean, a lot of it's locked in. It's demographics, it's political, it's a gridlocked Congress, it's military spending, it's geopolitical, it's all the above. But I think the broader, more structural thing is that over the past 40 years, there's been constant deficits for the most part, rising debt to GDP, but that's been offset by 40 years of declining interest rates. And so interest expense was never really a problem. If you double your debt, but you cut your interest rate in half, then your debt servicing costs are not really a problem, right? And so it's been 40 years of that math happening. And the problem is that if you are continuing to rise public debts and deficits, but your interest rates go all the way to zero and bounce off zero and then start going sideways to up, you no longer have that offset anymore. And so I think that's the bigger factor for what's happening is that the kind of the natural conclusion of decades of deficits and debt accumulation is that we kind of enter this new period where interest expense starts to actually matter and they start to enter this kind of long-term fiscal spiral, which again doesn't mean anything major happens this year, but it means that this overall kind of fiscal train is not going to stop anytime soon. And it's this new background structure that as investors or any of us operating the economy have to contend with, that it's a different background structure than the prior decade.
I've noticed just by looking at the chart that the federal surplus or deficit, in this case the deficit as a percentage of GDP, has continuously widened over the last 40 years, like you've mentioned, Lynn, but has accelerated in its widening since 2008. And so if you just look at the charts, well, you would say to yourself, since 2008, the American stock market has seen the longest bull rally or market in history. Correlation, causation, who knows? But certainly a deficit doesn't hurt the stock markets. In fact, a widening deficit has boosted the stock markets. So just on the surface, I may make the argument that as an investor, I may want the government to spend more money, stimulate more, widen the deficit, because that's good for assets and nominal values of assets. Would you agree or disagree?
I mean, from an investor standpoint, probably, especially in nominal terms. I mean, in emerging markets, when they go through issues, usually things go up in their local currency term, even if they do poorly in dollar or gold terms. And I think what we're generally seeing is some of these developed markets, especially the US, have certain emerging market characteristics, just to a less extreme degree. And so if I had a view that they were going to dramatically cut the deficit tomorrow, then I would invest differently. I would own things like I would own more bonds, for example. So, but because I don't expect them to do that, I invest the way that I do. So yeah, you could say it's bullish on the assets that I want to own if those deficits continue, but that's why I've invested in them in the first place. It's a higher nominal regime overall. Um, and it can sometimes lead to a higher real regime if you're kind of sucking monetary capital out of other countries like places in Europe or places in Asia, for example. If the US is running this playbook, but investors are still fueling it because they don't know where else to invest, the risk comes when they do feel like they have alternatives and this spending's still locked in. And so if you get a repudiation of the bonds while this is still happening, they don't really have a way to slow it down. Investment decisions have to take into account the deficit, and part of why I'm long certain assets is because of that. And the last point I would make is that the challenge when they get to these high debt levels in this financialized of an economy is that even if they try to do austerity, even if they try to say raise taxes and cut spending, that would be bearish for a period of time. But then the problem is that tax receipts are so heavily correlated to asset prices now because we've become so financialized that by cutting that, you would likely depress asset prices for a period of time, which would then ironically increase the deficit again. And so it's actually a very hard tailspin to get out of fiscally when you have the combination of this high public debt built on this financialized of an economy. There's really not that many outcomes I see that change that, which is why I invest structurally the way that I do.
Okay. Is there a Goldilocks scenario in which the government spends money and perhaps widens the deficit, but we don't get inflation to run out of control? In other words, MMT, in a scenario in which we have stimulus, which would be good for equity markets in nominal terms, but we don't get a runaway inflation. Could that happen?
So that would happen in the context where energy is abundant, right? So a lot of new energy supply is coming online to kind of keep up with that. And two, you have deflationary offsets from things like AI or other tech. So for example, if you ran very, very large deficits, but those, for example, if you ran very large deficits, but you used it to, go get copper mines and build nuclear plants and data centers and things that were highly productive, it might or may not be as effective as the private sector, but at least you'd bring new supply online at the same time as you're debasing your currency, so you can minimize how much on a kind of a per currency basis these things are getting more expensive, if at all. The problem comes in when you run this big fiscal deficit, but it doesn't go toward increasing the supply of goods and services. It goes more toward consumption or more toward locked in demographics or towards war or things like that. They're not really kind of fueling that real GDP growth. AI or energy abundance helps keep CPI down, but you're still running these big deficits, then that inflation will generally show up in asset prices. It'll show up in things like gold and Bitcoin and high quality equities and high quality real estate. That's where that inflation will show up. Whereas if you do get energy bottlenecks or AI does not offset things as quickly as some people expect, then more of that would show up in CPI. And you'd be a little bit more careful of some of those, high multiple growth equities, for example. So if you're not sure about this kind of the ratio of where that inflation will end up, then one thing you can do is kind of invest in the middle, which is to say own things like gold and Bitcoin and energy stocks, for example, and kind of high quality assets like that, but still be cautious around the most highly valued growth equities that might get punished if some of that inflation does show up in the CPI.